So what are the 5 questions that we need to be asking ourselves before we officially make the decision of retiring? My name is Sebastian Guerra, president and partner here at Guerra Wealth Advisors, where we help families get to the point where work becomes an option and not an obligation. If you really enjoy the subject about retirement, taxes, investing, estate planning, long-term care planning, or maybe asset protection planning, please make sure that you subscribe to this channel. Every single week, I put out a brand new video where we talk about all these different subject matters as it relates to our money, especially as we're entering the stage of retirement. You see, today we're going to be talking about the 5 questions that we need to be asking ourselves before we officially make the decision to call it quits and retire. So I recently met with Mark and Linda. He was 62 years old, wife was 60 years old, and they were trying to get to this point where they can officially make the decision and retire. They were married, they had no mortgage on any of the properties, they had 2 grown-up children already, and Mark was retiring from a corporate job in the following year, and they had a total of about $2.5 million between all of their investment accounts. Linda also had a rental property, and she was planning on retiring in the next 2 or so years. Now, what was really interesting was that they were really concerned about taxes, because as you're entering the stage of retirement, now you're starting to think about, well, what happens if taxes go up? How are taxes going to affect me as I start taking money out of my retirement accounts? And then the other thing that they were concerned about is what's going to happen the day that I can't take care of myself anymore? What's going to happen when I'm 80 or 83 or 85 years old and unfortunately I get Alzheimer's or I get Parkinson's or something happens to me where I need some sort of long-term care? And then the other question that they had was, what's going to happen with all of my legacy? So now that we know what are the biggest concerns that they had before they entered the stage of retirement, the first question we want to ask ourselves is, how much money am I going to need every single month to make sure that I can maintain the quality of life that I'm accustomed to today? And this is why usually what we always recommend that we ask ourselves the question, if today was your last day of work and you never went back to work ever again a day in your life, how much money would you want on a monthly basis to maintain your quality of life? In their case, they needed about $6,500 on a monthly basis just to be able to maintain their basic living expenses. But then that didn't include, unfortunately, things like travel and hobbies and birthday gifts and Christmas gifts. And when you added all of that up, that was an additional $3,000. You see, I think this is where a lot of people, they make this mistake before they retire. They say, well, I can live on $5,000 or I can live on $6,000. But then when you begin to add all the discretionary expenses, sometimes that expense can literally go up by 30, 40, or 50% every single month. Which in their case, it went all the way from $6,500, which was their basic expenses, down to $9,500 when you added up all of the travel and hobbies. So what is it that we did? The first thing that we did is we built what's called a cash flow plan that separated what are called needs versus wants. Now, why is this really important? Because needs is what we know we need on a monthly basis just to be able to maintain our basic living expenses. Now, wants allows for now flexibility based on how things are happening in the market. So a lot of us, when we're entering the stage of retirement and we get to 60, 65 years old, and we now know that we want to maintain this certain standard of living, well, the question is, where am I going to get all this income from on a monthly basis? And not only where am I going to get it from, but how long is my money going to last? And this brings us up to question number 2. Where will your retirement income come from? And you want to make sure that it's mapped out every single month. So like in their case, they were going to be getting about $4,200 a month starting at age 67. Now, the reason this is very important is because if you're planning on retiring, say at age 60 or 62, but your Social Security check is not until 67, then you want to now start asking yourself, well, how are you going to cover all of those expenses between, say, 62 and 67? Do you have enough money inside your investment accounts, your retirement accounts? And then is Social Security going to really cover all of your expenses? So they know that they were going to get about $4,200 a month. They also knew that they were going to get about $2,000 a month from a rental property that they had, which that's a little side note that I can tell you. A lot of the families that we sometimes meet with, they'll say things like, well, I'm getting $3,000 a month from rent or $4,000 a month in rent from a rental property. But sometimes it's not what you're generating in rent, it's what you're profiting from that property every single month. And in their case, they were getting about $3,200 a month, but when they subtracted all of the maintenance expenses that that property had, that was only leaving them about $2,000. When you start adding up property taxes, insurance, HOAs, and all expenses that can also come up, that can sometimes bring down the profit of the actual property. So another very important thing that you want to think about as you're entering retirement. You might want to have rental properties, but the real question is, what's your net profit based on the value of that property? And then what they were going to be doing is that they were going to be withdrawing the remaining amount of what they needed, because they needed about $9,500 to pay their bills. They were going to be pulling out the remaining amount from their retirement accounts and brokerage accounts. So what is it that we did? You see, I believe that one of the biggest challenges that a lot of people go through is that when they're entering the stage of retirement and they're short maybe $3,000 or $4,000 a month, they don't really know where they should be withdrawing the money from on a monthly or a yearly basis. And so this is why it's very important that we structure something called a bucketing strategy. And what does that mean? So normally a bucketing strategy means you're going to grab your money. In their case, they had a couple $1,000,000. You want to grab your money and you want to break it up into different buckets for specific goals and objectives. So usually the first bucket that you always want to make sure you have is what we call your cash bucket. That's normally to hold your emergency fund. That's normally maybe hold 3 to 6 months of expenses. So in their case, if they needed about like $9,000 a month to cover their expenses, normally you're going to want to have in there maybe anywhere between $27,000 and maybe around $50,000 or $60,000 inside that bucket. But again, that is only for emergencies. You don't want to go and have in there $200,000, $400,000, $500,000 because the money in there is losing value because of inflation. Now, the second bucket you want to make sure that you have is what we normally call the income bucket. This is the bucket that you're going to be drawing from on a monthly or yearly basis to help cover the shortfall that you have from the income that you don't have enough from all of the other sources. So in their case, they were going to need about $4,000 a month, and they want to make sure that those funds are coming from what's called your more income safe driven investments. And this is where you can be using things like bonds or dividend paying stocks or annuities as well. Now you can get into what's called your third bucket. And your third bucket is what we call your long-term growth and risk bucket. This is the bucket that you understand and we understand that it's going to go up over time, but you have to be willing to ride the roller coaster along the way. And I think this is one of the challenges that a lot of people go through as they're entering the stage of retirement. They might have a bunch of accounts laid out in a bunch of different places, or they might have a 401k with $1 million, but there isn't a very clear strategy on the way that $1 million is to be structured as you're entering the stage of retirement. So it's very important that you implement some sort of bucketing strategy based on the goals that you're trying to accomplish. Now, the third question is, how much will you be paying in taxes during retirement? You see, one of the challenges that we're going to walk through as we enter the stage of retirement is, well, we have no more income. And if we have no more income from our jobs, many of us think, well, I'm not going to really pay a lot of money in taxes because I'm not working. And if I'm not working, then I don't have income. So if I don't have income, I'm not really paying Uncle Sam a lot of money. But is that really true? Well, you see, if you have money right now in a 401k or an IRA or a 403b or any retirement account through your job, you see, all of those accounts are what's called tax deferred accounts. And what that means is that every time you withdraw money in the future from that account, you're going to need to report that money on your tax return. So why is this topic so important? Because as you're entering retirement, you also want to ask yourself, well, where am I going to go and pull those extra $4,000 a month that I need to cover my bills? Am I going to pull it out of my IRA? Am I going to go pull it out of my 401k? Am I going to go pull it out of my Roth IRA? Am I going to go pull it out of my brokerage account? Because if you create a very solid strategy on where you're withdrawing your money from on a monthly or yearly basis, you can pay a lot less money in taxes than if you just blindly said, I'm going to go and take out $4,000 a month out of my IRA. But instead of just pulling out $4,000 out of your IRA, what if instead you broke it up into withdrawals coming from different buckets? That can allow your tax bracket to go down, which means you're paying less money in taxes. By the way, if you're looking for ways to eventually get to this point of retirement, which for us what it means is getting to the point that you work because you want to and not because you have to, you want to make sure that you have a solid plan in place. If you wanted to do a free review of your entire financial plan, don't forget to click on the link below and schedule a meeting. Now you see, this family, after we look at their overall picture, they were going to have to report over $80,000 of taxable income, especially once the RMDs kick in. Now, if you don't know what an RMD is, it stands for Required Minimum Distribution. And pretty much this just means that once you hit a certain age, the government starts forcing you to start emptying out your retirement accounts at a specific age. For many people today, it's around age 73. For many people that were born after the year 1960, it's going to be age 75. And this means that at that age, the federal government is going to force you to start withdrawing money out. So what is it that you might want to consider if you're entering now this stage? You might be thinking, well, if I right now am planning on retiring and my income is not, $100 or $200 or $300,000 anymore. So something that you might want to consider is that before you hit that RMD age, call it age 73 or 75 years old, you might want to start taking advantage of converting your money from IRAs over to Roth. Because remember, the bigger your retirement account is at that RMD age, the federal government will force you to take more money out. So how can you avoid that from happening? Well, what you can do is you start moving money from IRA over to Roth, because once the money's inside a Roth IRA, you don't have the requirement anymore from the federal government to have the RMDs take place. So you're not forced to have to start withdrawing money out of all of those accounts. Now, another strategy that you could implement is you can sell appreciated stocks that have had capital gains, and you can do this during low income years. Now, what I mean by that is that sometimes what happens is that when we retire, sometimes our income really goes down. But what a lot of people don't know is that if you have no income at all, right, no Social Security income or work income at all, you can actually sell, as a married couple, almost $100,000 of capital gains every single year and not pay a dime in tax. I'm going to repeat that one more time. If you right now are married and you have no sources of income, right, no Social Security, maybe you're not withdrawing any money out of an IRA, you have no work income, you can withdraw money out of your brokerage accounts and you can sell up to almost $100,000 of gains and pay no taxes on that. So why is this important? Because if you're entering retirement and your income goes down to pretty much zero, you can now implement a strategy where you slowly begin to sell some of those gains, and you can start moving that out and not have to pay any taxes on any of those gains. But you want to make sure that you're strategizing this as you're entering retirement. You see, it's not just about having good investments, it's also having a very solid tax strategy. And in their specific case, we were able to save them over $250,000 in taxes over the next 15 years, just simply by strategizing on where they were going to withdraw their money from throughout retirement. So the fourth question we want to ask ourselves is, well, what's going to happen if I'm now 80, 85 years old and now I need long-term care? You see, guys, I think that one of the challenges that some of us will eventually go through is that we don't want to face the reality that we're going to get to a certain stage in our life where we will not be able to take care of ourselves anymore. And many of us need to start asking ourselves the question, well, who's going to now take care of me? Is it going to be my family? Is it going to be my spouse? Is it going to be my children, my grandchildren? And we all know of the stories where sometimes you've had now the children have to step in and take care of mom, take care of dad, because maybe mom or dad doesn't have the financial resources to go and pay someone, or maybe they just want to have the kids right next to them taking care of them. But the question is, do you want to put that burden on your children? Do you want to put that burden on your grandchildren? And so as we begin to think of this subject of long-term care, the question is, what's the plan that you have in place for when that day does happen? You see, this isn't to say that you should go and buy a long-term care policy. This isn't to say that, hey, you should be scared about what's going to happen in the future. It's just you want to make sure that you have a plan in place for when that day does happen. Because there's about an 85% chance that between you and your spouse, if you're married, one of you two are going to enter a stage where you need long-term care. And normally what we see is that a lot of men are the first ones to get sick. And they're normally a few years older than their spouse. They normally end up passing away sooner. They're the first ones to get sick, which normally means that he is normally the one that actually needs more care sooner and ends up draining a lot of the money that they have as a family for their retirement. It gets spent on their medical care. So you want to make sure that you have a long-term care strategy in place for when that day does happen. Doesn't mean that it's going to happen, but there's a high likelihood that it will. And the question is, how much is it going to cost? Because I can tell you right now, in America, depending on what state you're in, that can be costing you anywhere from $5,000 to as high as $15,000 or $20,000 a month today. The question is that if you're 65 years old right now and you are probably not going to get sick until 20 years from now, well, what is long-term care going to cost me in 20 years when inflation kicks in? Because if it costs me right now $8,000 to have in-home health care, but then in 20 years, that's going to be $22,000. Well, where is that money going to come from? And it's probably going to have to come from some of your investments, some of your accounts, because the federal government doesn't just give you someone to take care of you. Normally, that's done for people that qualify for Medicaid. And for people that qualify for Medicaid, you normally have to be a low-income, low-asset individual. And if you've saved up any money really for your retirement, you're probably not going to qualify for Medicaid. So you want to make sure that you have a strategy in place to make sure that you can cover those expenses when it does happen. So one of the things that we did with them, they had about $150,000 in a CD that they had. It was paying them close to about like 4 or 5% in that. And one of the questions I asked them was, well, what's the plan with the $150,000? And their answer was, well, I mean, if eventually I end up getting sick, I want to be able to have that money for that. But the problem with that is that what happens if the medical care is more than $150,000? And what's going to happen is all the money's going to now start getting drained, and now they're going to start eating all of the other accounts. So what we did instead is we grabbed that same $150,000 and they set up something called a hybrid long-term care policy, which also includes life insurance benefits. And the benefit behind that is that those same $150,000 was able to buy them about $850,000 of insurance. And that means that the day that happens where they end up getting sick, instead of them now only having $150,000 for long-term care, they now have $850,000 that they can use as a couple as well. And the benefit of that is they can start using that for someone to take care of them at their house, or they can go to a nursing home or an ALF facility, but they have a larger pot of money that they can use for those long-term care expenses. But if you're using one as a hybrid policy, it also includes a life insurance benefit as well to your family, which means that if you don't use all the money for long-term care necessities, you can also pass that money over to your family as well, any money that was not spent as a traditional life insurance policy. So in their case, they have $850,000. Let's say they only end up spending $400,000 on long-term care. Well, there's $450,000 they never got to spend during their life. Those $450,000 can still pass on to their children or their heirs as a life insurance benefit. So technically, they spent $150,000 for $850,000 for their benefit and also their family benefit. So the fifth question we want to ask ourselves is, what legacy or estate plan do you have in place today? You see, one of the problems that a lot of families have as they're entering this later stage of life, not only just retirement, but when we get into our 80s is, well, who's going to get everything that we leave behind? You might have investment accounts, retirement accounts, brokerage accounts, savings accounts, checking accounts, maybe cars, real estate. You have all of these assets, but who's going to get all of this? And not only who is going to get it, but who's going to be able to make decisions on your behalf even before you pass away? And that's why it's very important that you start thinking about things like, well, who are you going to assign as your financial power of attorney, right? Who's going to be that person that will make financial decisions for you when you cannot make financial decisions on your own? Are you going to assign your spouse? Are you going to assign your children? The other question is, who are you going to assign to make healthcare decisions for you? Maybe you don't want to put your spouse or you don't want to put one of your children because you don't trust them with the healthcare side. So those are questions we want to ask ourselves as well. Also, have you looked at every single account that you have, every rental property, every investment property you have, your primary residence, every account you have at banks, every investment or retirement account you have? Have you looked at the beneficiaries of all of those accounts? Because sometimes what I've seen is that you might have your spouse as a beneficiary as 100% on one account, and then maybe on other accounts you now have your children, but your spouse would need that money in case you were to pass away. So you also want to make sure that all of your beneficiaries of all of your accounts are set up the right way based on what you're specifically trying to accomplish. I see it happen with a lot of families that they'll just leave 50% to their children and 50% to their spouse, but they're not thinking about the consequences that can bring to their spouse if their spouse cannot live on that 50% if something were to happen to you. So you just want to make sure that your beneficiaries are set up the right way. And if you want to create some sort of structure where you want to make sure that your assets get distributed at specific orders and specific times, then that's where you might want to consider something called the revocable living trust. So that way your money doesn't necessarily go to your spouse or goes to your children. All of your assets already go into the trust. So your beneficiaries would not be your spouse. Your beneficiaries would not be your children. Your beneficiaries would now be your revocable living trust. And then as all of your assets go into that, that revocable living trust will have specific rules and conditions on the way you want that money and those accounts to be handled when you're not here. But this is something that you should not only be talking with your financial planning team, but you also want to make sure that you're talking with an estate planning attorney. And you see, what happened with Linda and Mark after this conversation is we noticed that they hadn't done any changes in the last 12 years. They hadn't looked at any of their accounts, any of their beneficiaries. Their house was only titled under one of their names. That means that if that one ends up passing away, then the remaining spouse would have to go through probate just to get control of that house. So this is why it is so critical that you go through something called an estate planning audit. It's not just, do you have an estate plan? Is it all titled and set up the way you want it to today? Because maybe you set something up 5 years ago, 10 years ago, 20 years ago. But the question is, what you decided 20 years ago or 10 years ago, is it still what you want today moving forward? And that's why it's not only important to set something up now, but also keep it updated on a regular basis to make sure that what you wanted today is also the same thing that you want maybe 1, 3, or 5 years from now. But that's why it's important to do consistent audits of your estate plan. So in summary, after we ended up meeting with Mark and Linda, we realized that now they had a solid income plan for the next 30 or more years to make sure that their money can last them all throughout retirement. We were also able to put together a tax strategy that can save them hundreds of thousands of dollars in taxes by just implementing a few tax strategies on a yearly basis. We also made sure that we went through what's called asset protection planning, just in case they end up getting sick, there's a long-term care plan in place for them. And the last piece is also making sure that they had a legacy plan in place that was aligned with their family values. So one of the interesting things that Mark and Linda ended up telling me right after the conversation was that they now felt that they can actually retire on purpose and not just hope, like a lot of people, that eventually it works out. I think that's one of the biggest concerns that people have as they're entering the stage of retirement, that they now have all of these accounts and they don't really know if they're going to be okay during retirement. But this is why a financial audit and asking yourselves these 5 important questions will carry you through retirement. If you know someone that's planning on retiring over the next couple of years, don't forget to grab this video and share it with them so that they can make better decisions with their money. I'll see you guys on the next video. Take care.